You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, welcome back to TWIFO, This Week in Futures Options, the program where, as the name implies, we break down the week that was, and in some cases still is, in the world of futures options. So what's hot? What's lighting it up out there? Maybe it's out there in the ags. Maybe it's in the energies. Maybe it's the metals. Maybe it's all of the above. We don't know until we start digging in. And then we'll dig it in. We'll break it down for you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If I sound a little bit different, it's because, yes, I'm still coming to you live from the Southern Studios here. One more week here, finishing out the week here in the old Southern Studios, and we're back to sunny Chicago next week, where everything will sound great. It won't change for you guys on the podcast. Those of you joining us live, unfortunately, you get no drops. You get the raw, hardcore, the way we used to do it old school on the network back in the day, listeners, before we had the drops live and everything else live. So you get in a nice old-fashioned way, a nice glimpse into the past of the Options Insider Radio Network. But it's still cool because you guys can answer questions and see how the sausage is made after the fact. And however you listen, whether it's live or after the fact or via some sort of Croatian podcast client, however you do it, make sure you hit us up. Questions, comments, insights, pearls of wisdom. We love all of that good stuff. We read them all, even if we don't get to answer all of them on the old show. And, of course, you can always find our stuff, as usual, your iTunes, your TuneIns, your Stitchers, your so-ons, and so forths. And if you want to follow along live with the show, or you could do it after the fact, you've listened to the podcast as well, it all works. Head on over to cmegroup.com/TWIFO this week in futures options, and you get the reports, the same reports Nick and I are looking at right now. We're going to break down for you on the show. Nice little added nugget for those of you who can join us live is that you get to do it. You get to click on the links as well. Those links are all live. So if you see a month and it's attractive to you, say, hey, what's going on in that month? You can click on that link and dig up more. That's not going to be the case on the podcast version. So a little added nugget for those of you who can make it out there live after the fact. And, of course, joining me, as always, on the old TWIFO show, my cohort, my partner in crime, Mr. Nick Howard, the creator of Quick Strike. Mr. Nick, welcome back to the TWIFO program, sir.
Hey, how's it going? Look, watching. Let's get a little audience build up here. Although it's a long weekend, so it's going to be tough to see what happens here with our live group.
Yeah, we're heading into a holiday weekend here in the States, so a lot of fun stuff to be had, but a lot of fun stuff for us to talk about on the old show as well. And let's kick things off, Mr. Nick. What are you feeling here on the old show? I'm thinking since everyone's still and their mother is still talking crude, I think we got to start there because that is where, of course, all the rubber has been meeting the road this week out there in crude land. We were talking last week about this somewhat surprising sell-off out there in crude, with crude WTI dipping down as low as in the 43, 42 range. This week, kind of a bit of a reversal of fortune out there in the black tar, the Texas tea, with most of the futures across the term structure rallying about 3 handles. So a pretty aggressive move up 6, almost 7% this week compared to this time last week. So interesting stuff. All you people writing in saying, hey, how do I position for crude as a bull, et cetera, et cetera. This was a good week for you. A lot of people were looking for a turnaround. I guess that's exactly what we saw this week. Interesting stuff. As we've said before, when it comes to crude down, it's kind of like an equity and an index in these days, in the sense that down typically equates to vol, up typically equates to less vol, and that's pretty much what we saw this week. A strong upside rally, the vol came in pretty aggressively in about 3.5, sometimes 4 points, depending on where you're looking across the board. So we needed to see, if you wanted more juice, more vol, we needed to see crude not to stay where it was last week, but actually continue to recede a little bit, and we saw exactly the opposite. So, of course, vol coming in pretty aggressively. Nick, this has kind of been a constant refrain for us here on the show. It's crude vol these days is kind of just like quicksand. You can't really hold on to it that long. It just slips through your fingers. Is that kind of your feeling as well? You get a little bit of a taste of it, a little bit of a feel of it, and then it's gone.
Yeah, I just don't know what people expect in terms of this underlying movement, because we talked a little bit about it last week. Just how everybody wants it to run up, but it can only go so far down. I don't think we're going to see those lows that we saw in the past. I think it's a trading range, what it looks like right now. You have a 7% move in a week, and there's some range to that move, I think, here a little bit. There should be some trade. And I think that becomes fairly obvious when you look at where some of the activity was. I mean, we had some movement. We didn't have a great deal of back and forth here, but one thing we've been talking about over the last few months are the weekly options, and you saw some significant trade this week in those. So there's some short-term stuff people are playing on. But yeah, I think we're in a crude oil quag. I was going to call this the Beverly Hillbillies show, right? Because we're going to do gold, regular gold, and the black gold, right? The Texas tea. So this is a Beverly Hillbillies commodities. I think that would be I'm going to do a # Beverly Hillbillies. Right, for all those Twitter people out there.
I like it.
And I'm
Jethro.
I'm going to keep using #.
I'm trying to remember the rest of their names. All I remember is Jethro. There was a grandma.
Ellie Mae.
There was a
Jethro and
grandma,
Ellie
right?
Mae.
Yeah. Oh, yeah, Ellie Mae.
Yeah.
She was like the Daisy Duke. She was before Daisy Duke.
Yeah, that was a good. Yeah, those were good shows, black and white for a long time, and then it was color. No, so
Quality
yeah,
stuff.
it's sort of like you're in a big vat of oil and you can't really move. It's not deep, so deep that you can sink, but you really have a tough time keep slipping, right? You think you're getting up the ramp and you keep slipping right back down. So yeah, it's lower, and we're again, you start looking at we start looking at the historicals on this stuff. We're approaching some pretty low points here, so it's going to be I think it's going to be a long summer for oil.
Yeah, we'll see. It's interesting stuff to break down. If you're wondering how the volume was shaping up this week, it was pretty much number one with the bullet was out there in the front month with the AUG lighting it up to the tune of about almost 43% of volume. That's pretty typical out there in WTI, where it hovers usually just shy of half of the volume going up in that front month. Some weeks, some aggressive weeks, gets a little bit heavier, but typically in that 40+% range. That's pretty much what we saw this week with the number one trade, number one with the bullet. I'd have you guess, Nick, but I know you're looking at the platform as well, so you're seeing it along with me. They are, of course, the AUG 48s lighting it up, so maybe that's reflecting the return of bullish sentiment out there in crude. We certainly saw a nice rally this week. 48, not exactly as outlandish as it seemed maybe a week ago, Nick. But the 48 strike lighting it up. A lot of that opening, about 31, almost 32,000 contracts going up. About half of that coming yesterday on Thursday, 15,000 and change going up yesterday. About 12,000 of all those contracts opening this week. So a lot of churn, but net opening on the strike this week, which is kind of interesting. Number two, we drop off quite a bit, actually, are the 45s out there in AUG also as well. About 21, almost 22,000 of those bad boys lighting it up. The lion's share coming actually on Wednesday, about 8,000 of those bad boys moving in, about 3,000 on Monday, so pretty active this week. So the Bulls, a little bit nearer term upside love there on the 45s. That's actually a lot of back and forth. It was net opening, but only just slightly on the week. So clearly a lot of back and forth trading on that 45 strike, which was, depending on where you look this week, a little bit out of the money, a little bit at the money, almost a little bit in the money. So that was a pretty active strike this week as we continued to vacillate all around the mid 40s. And of course, the even money strikes also attract attention. That was not any different this week as well, with the 50s lighting it up to the tune of about 16,500 contracts. The lion's share actually coming on Wednesday as well with about 4,300, and then about 4,000 on Monday. So Monday and Wednesday, the big days out there. Net opening, but just about slightly, about 2,000 or so on the week. So again, a lot of back and forth trading on that whole strip from the 45s to the 50s on the call side, as you probably would expect in a week where we saw a pretty aggressive rise out there in crude. Of course, the puts weren't forgotten, but they were a little bit of a distant memory this week, with about the 42s being the most active puts on the docket this week. The AUG 42s, 14, almost 15,000 contracts lighting it up. Again, Wednesday and Tuesday kind of vying for the top 2 days there, with about 4,500 on Wednesday, about 4,300 going up on Tuesday. Again, a lot of back and forth churn on that strike, pretty much a net slightly opening, but a lot of back and forth. So seeing a lot of back and forth action on this, which is interesting and also healthy. And we've seen the 43s also lighting it up, 43 puts with about 14,600. So just slightly less than the 42 puts. Again, the big day this time on Thursday. So kind of interesting, Nick, to see the dichotomy of trades on the different strikes and also the different days that were active. You'd think the puts and the calls would move a little bit more in lockstep, with the calls going one day, the puts another, but not so much. Kind of interesting. Thursday, Wednesday, Tuesday, all very active days this week when it came to the futures options activity out there in crude. Again, about 6,500 of that 14,000 and change, so almost half coming on Thursday. Of course, it's not all front month. It's about 44% front month, but it's not all front month out there in WTI these days. Nick mentioned the weeklies. The weekly 45 calls actually expiring effectively today, so these are going out. We're pretty active as well with about 1,700. Nice to see the weeklies kind of lighting it up. If we go out a little bit farther as well, Mr. Nick, out to September, we saw some bulls loving it up to the tune of the September 50s, with about 12,000 and change going up this week. So 50 calls. Again, that kind of even money 50 strike. Pretty active across the board, with active in October as well, about 4,000 of those bad boys lighting it up out there this week. And, of course, all the way out there in June of 2018, June 50s, also lighting it up to the tune of about 3,200. When you get out to decent next year, though, 50 is not enough. You got to go to 60. The 60 calls lighting it up to the tune of almost 4,000, 3,700. And if that wasn't enough, Nick, there were some long-term bulls out there to the tune of the Dees 2019 calls, the 80 calls actually, lighting it up for exactly 2,000 contracts this week. So kind of a pick your poison across the board here, Nick. Puts active, calls active, near term, longer term, even some weeklies. What was it that caught your eye out here this week? And also break down what you saw out there in the quick skew and Crude this week.
Yeah, I think the one thing I noticed from a volume standpoint anyway is if you take a look over in the last column grouping, the volume column grouping, you're going to see that the puts dominated the short-term trade in the weeklies for the most part. So you saw more puts taking coming on board from an activity standpoint for the 0-day, 7-day, and 14-day contracts. And then as you went out into the later dated or the regular contracts, right, the serials and we don't even call them, we just call them the monthly contracts. You saw more of a bias towards the calls, and I think you're right on in terms of what you were pointing out. I mean, we saw just. And as you rally back up, right, we didn't rally that much from a future standpoint. We did 7%, but it's, $2.5, $3. But a lot of activity above where we are right now, from 48 all the way up to 60, as you mentioned in December 2018. So, it's a fickle bunch. Like we've been talking about all along. It just, everybody was, terrified that we were going to keep going below, and then now we're now we're right back where we were. And I think, if I jump over to the quick skew and start looking at what's happening over there from a volatility standpoint, as you mentioned, the vol's down quite a bit. We're probably starting to, breach toward the lows that we've seen over the last couple of years. Probably not quite there just yet, but we got hit pretty good. As you mentioned, we're going to expect that as we move back into the middle of a range. But we saw the skew itself, the 25 delta risk reversal. We saw that get pretty positive. So that's pretty much showing us skew is going to show us the difference between the call and the put, and then the quick skew is going to show us the difference between the call and the put in terms of its richness or cheapness to the at the money. So I think just from a general standpoint, we're seeing a pretty not such a tilted curve between the 25 delta options, right? So we see a little bit of put premium and a little bit of call depression, but the general spread there is not too much from a volatility standpoint. So I think it's going to start this teeter totter between. Let's take a look real quick and see what it looks like. If we look at the 48-day option, which is a September, and we look at the pricing sheet, we're going to see that 25 delta strike is a 43.5. So that's about $3 out of the money on the upside, and about the same $3 out of the money on the upside. So you have like a $6 range here in the crude when you're looking at this 25 delta to 25 delta, and it's generally speaking, less than one vol point difference between the two. So I think we've got our range established for the most part here. We tested the bottoms earlier last week, and now we're right back sort of in the thick of things. And if I go out and look at the open interest for the September contract, we're going to see the same thing we've been seeing over the last many months. High 40 puts, high 50 calls, with a big put barrier over in the 45 strike now, and that might be. We'll see what happens with the open interest coming in from today's trade going into Monday. So, range bound again. I think we're going to see a little bit of more of a, sort of that steady flattish cup from a vol curve standpoint, and we might see these ranges. We might see 3.5% around the money here next week, especially, right? It's got to be pretty quiet, I would imagine. You're going to have a lot of people taking off on Monday, Tuesdays off, coming in Wednesday a little bit with a holiday hangover, and some people taking that day off as well. So it'll be interesting coming at the end of the week as we get to non-farm payroll. The market should pick up on Thursday and Friday, but I think what do you think? Usually after the holiday, you see like it's a little gappy, where we might see a little bit of a push up again because nobody was around or somebody took a long weekend already and started Friday, so maybe the markets got pushed up a little bit. So I think we see some trade around this 45 futures price, and maybe a little bit of air up or down, but I don't think we're going to be seeing too much in terms of one direction or another, especially when you start to look at the quick skew and the separation between the 25 delta put and call, and seeing it's pretty flat there.
Yeah, I'm with you there, and I was just taking the pulse of our listeners here. I wanted to know which commodities and which futures options are kind of on their radar right now. We gave them 4 choices right before showtime: gold, crude, corn, and the dollar. And as of right now, crude actually in second place, Mr. Nick, with 36%. So maybe we buried the lead because gold, 45%. A lot of our listeners liking themselves some gold. I like this when they can choose for us, Nick. That makes life a lot easier, doesn't it? So our listeners clearly got gold on the brain. I think I can probably figure out why that might have been. Gold kind of started the week off a little bit rough, Nick. I'm sure you saw this as well. It was the talk of a lot of outlets. I think Bloomberg had a write-up on it as well. There was, I guess you can call it the proverbial fat finger out there in good old gold. We saw 1.8 million ounces trading in just about a minute. So 18,149 contracts, which is a lot. That's quite a bit. That's pretty much, if you break down the actual amount of gold that's in that trade, 1.8 million ounces, that's larger than the gold reserves of Finland. At least according to Bloomberg, who was looking at this trade earlier this week. And a lot of people looking at this and pretty much saying, the trade doesn't really make a lot of sense. The 18,000 plus contracts an hour later, it was just back to the average of about 2,300. So clearly it had the stamp of perhaps someone typing away at the wrong. We've all been there, Nick, when we were, assistant traders, young traders. I personally moved the Dow by accident a little bit in the after hours one night. So it's easy to do these kinds of things when you hit the wrong button. Our friend here decided perhaps maybe he wanted, instead of 18,000 ounces, 18,000 futures contract, which is a lot. And so perhaps he moved that. But all that set the tone for an interesting week out here in gold. We saw the sell-off kind of continuing net on the week here with the futures off net on the week, about 15 handles, so a little over 1%, hovering at the 1240 range out there again this week. So the will they, won't they dance in gold continued to lean towards the won't they this week, with no love for all the gold bugs. I'm sorry, gold bugs, I know you're out there, but no love for you guys this week. And if you ask, where was the love? Where was the action? Where was the number one trade with a bullet this week? It was out there in the AUG 1300s. Again, the front month accounting for a little bit over half, about 55%. This week, the weeklies not really doing so much. You got a few hundred lots out here and a few others, but really the weeklies aren't the story in gold so much. It still pretty much is the front month, and it was the front month. Nice even strike trades leading the charge yet again. The front month AUG 1300s lighting it up to the tune of about 5,700 contracts. So you're talking out of the money calls leading the charge, 5,700 contracts. The lion's share about 3,600. Come in on Wednesday, about 2,000 of that opening. So net opening pretty strong on the week there on that strike. So maybe some gold bugs taking advantage of a dip, buying the old proverbial dip, as they say. Followed hot on its heels, number 2, by the AUG 1200 puts. So again, even round numbers attracting people this week. The 1200, 1300, risk reversal, strangle, call it what you will, lighting it up this week. 1200 puts going up about 4,500 times. The lion's share of those coming on Tuesday, about 1,700. Again, about 1,500 of that 4,500 opening on the week. So net pretty strongly opening this week as well. Then we get down to the 1230 puts, a little bit more reasonable, a little bit closer out of the money put there, with about 4,200. The lion's share coming on Thursday, about 2,200 of those bad boys. Also primarily opening this week as well. So a lot of opening downside. Again, you see the sell-off continue. Not exactly surprising that people will be opening a bit to the downside, perhaps a little bit concerned about all the love. It is surprising that the 1300s were number one this week, though. So that certainly is something not expecting. Again, you guys can follow along. CMEgroup.com/Twifo to see exactly what we're seeing right now. Number 3 would be the old, actually, what kind of breaks out a little bit. That's the nice thing about gold is that it does trade primarily in the front month, but there are some other months that also trade as well. And we're talking, of course, about the SEP lighting it up this week as well. The SEP 12 halves also lighting it up. 1250s, about 4,000 contracts and change. So front month, most of the action, but not all of it. SEP also getting some love. Also kind of the at the money strike there. So not some far out of the money 1,300 strike. The at the money is with about 4,000 contracts. Let's see how those broke down throughout the week. About the lion's share coming actually on Monday. About 2,000 and change of that 4,000 going up on Monday. The rest scattered throughout the week and mostly opening again. So a lot of opening paper out here this week as well. And it may surprise you because it's kind of the opposite of what we saw out here in crude. But when you look at crude, when you look at gold, when it sells off, we see the vol coming in a little bit again, which is kind of reminiscent of how a lot of the juice has been to the calls of late, and the puts not so much. So when we continue heading downward, we see some lack of love, shall we say, for the old vol. Looking out longer term a little bit here, though, it wasn't all near term. It actually was a little bit longer term as well. With a big chunk, actually, a big block of 4,305, all going up in one print of these June 2018 1,400 calls. So if you thought the 1,300s were aggressive, you thought the gold bugs were back on the 1,300s. Nope, they're piling in on the 1,400s as well and going all the way out to June of next year to do it again. 4,300, all of that opening. So new opening positioning there on the 1,400 strike, as well as some D's 2018 the 1,300 calls, 1,500 of those bad boys lighting it up as well. So like crude, a little bit of longer term players coming in as well. Nick, a lot to unpack this week. Of course, gold's interesting story to watch. Not just a fat finger, but of course, there's a lot of other things baked in there. You have the dollar. You have, of course, the Fed, who just did their dance, probably not up on the radar again for a while. So a lot of things to unpack there with gold. But what was your take this week on all the hot gold action we saw out there?
Just basically reiterating similar to what we saw in the crude from a put call ratio standpoint, just a lot of calls going up, and you mentioned it as well. And the other thing of note, typically when, even though we see open interest up generally around 7.5%, depending on how many you have selected, when you click into the detail of the August into September and October and the November and Adis, you're not seeing a lot of rolls. You're seeing all in terms of one opening strike and one closing strike, and you're seeing all increasing open interest. So that means there's renewed interest in there's some movement, and there's people still on both sides of the coin deciding which way they think the gold is going to go. So we're obviously not going to see some closes. We haven't see closes because we haven't really moved away from a range of strikes. We're still sort of moving within our range, our 1,200 to 1,300 range of strikes, but you're still seeing strikes opening, and that's always good for the product, right? When you see a lot of green on the strikes throughout the week. So that's sort of the first thing I noticed. And then as far as if we go over to the vol, we've been mentioning this. Gold is really low from a historical standpoint, from an at the money volatility standpoint, and again, looking at that, I've actually determined, I got a little bit like narrow focused and looking at the quick skew, and I just was sort of looking at that number and sort of ignoring the old way of looking at the risk reversal. But what I realized, maybe moronically or not, is that it's nice having them right next to each other because you can get the relative distance they are from each other, but still see which ones are. Obviously you can see which one's rich or cheap from the number itself, but instead of having to do the percentage math in your head against at the money, you could just look at the risk reversal and see pretty much what that tilt is between the two. So, there's not a lot of vol between the 25 delta call and put. So even though the quick skew number might look like the call is much richer than the put, it's really pretty flat when it's all said and done from a volatility standpoint. So other than that, I'm not, again, we had the big sell-off, like you said, on Monday. We sort of bounced back a little bit, but sort of range traded from there. So I'm pretty sure that gold didn't pay the rent this week, just based on seeing that futures chart. But at the same time, when volatility is so low, not necessarily too much is required to pay the rent, right? So it might be a rent control district that they're talking about. When you have a low volatility, you don't have too much that has to take place in order for you to get your money's worth. But who would have expected that kind of drop off of whether it was a fat finger or not? It's still pretty interesting. Nobody's going to be playing for that to happen. So you sort of got down to that low part of that range, and it recovered, and it sort of traded around. So for me, outside, in these Beverly Hillbilly products here, is kind of a one-way street, kind of rangy, not much interest, and just sort of kind of moving through the week. And I think you're probably my guess would be you probably see the same thing next week. But, I've been on the floor when nobody was around too much, and we had some good movement in the futures for the exact same reason that nobody was around too much. So I don't expect a whole lot of activity in here. But again, that's why we watch to see what happened. We could talk about it next Friday. And anything else? Let's see, anything else of note there? Nothing really. Just like I said, good to see continued open interest. Good to see a lot of activity within that range of strikes, and on both sides of the at the money. So that means that there's interest and there's difference of opinion. That's about it on the gold side.
All right, we asked also people what they wanted to hear about. So we mentioned the ags, and then we mentioned the dollar, because dollar getting some love is kind of a corollary to the gold story. About 19% choosing the dollar. I'll let you pick, Mr. Nick. We had people talking last week about corn as well. We also have a lot of listener questions as well we can get to. So what do you want to do? You want to get right into the listener mail? You want to talk a little FX or maybe some corn? What's on your mind, sir? What are you feeling?
Well, I think let's jump into corn a little bit, just because we did spend quite a bit of time last week, and we probably would be remiss in not at least touching base about what we talked about. We discussed that what we coined the quick skew trade last week, and we're saying that the puts were pretty cheap in comparison to the calls. And we had a 14-cent rally here, 15-cent rally here, a big chunk of that happening today, and even prior to today. We saw the calls get a little bit richer and the puts get a little bit cheaper. So that quick skew trade spread widened quite a bit. Now, if you would have done that, and I think you still would have been in decent shape just based on how it's hedged. But I think that's something you got to continue to look at, especially if we retrace some of this gain. You're going to get down into some cheaper puts even still if the vol comes in a little bit again, and get an opportunity to put this trade on one more time. But it's widening, and I think if you go out there and I looked, and there's not much activity on the site right now from the audience in terms of looking at the report while we're having our conversation. But again, I think we really need to touch base every week with corn until we see what it's going to require for this quick skew trade to sort of start to tighten back up. From what we're used to seeing on this. And when we talk about what we're used to seeing, we see the puts move more toward the at the money in terms of a volatility standpoint. But the and the calls still stay rich to the at the money, but not quite as rich as they are right now. I mean, if you look out into the, let's call it a 60-day contract in September, there's 8 vol points that separate the call and the put. That's pretty significant, and that went up more this week. So, it's going to be interesting to watch that trade.
Yeah, the quick skew trade has been one to watch quite a bit. We talked about it last week on the show. I think we got some listener questions about corn. Well, we got a lot of listener questions in general, so maybe we'll just head into that. So without further ado, let's hit up your questions. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, welcome to the Futures Options Feedback. Like the man said, this is the portion of the show where we break down what you guys have on your mind. You have a lot of things on your mind, judging by all of this stuff you sent in. We also ask you guys some questions every now and then. And, recent weeks we asked you guys, hey, with broad volatility, the VIX kind of giving up the ghost, where were you looking for new sources of vol? About 30 of you said crude over things like metals and FX and even some individual equities. Looked like a good trade last week. This week, not so much. So hopefully you got the heck out of Dodge when the vol was a little bit higher. We also asked you about Bitcoin vol because you guys love to ask us about Bitcoin on the show. Is it getting too volatile for you out there? Only 19% said it was too volatile. About 41% said you want some Bitcoin options. 9% saying you're still bullish on Bitcoin even after all this drama of late. And this week, we asked you a couple of things. Last week, Mr. Nick, we asked everybody, crude oil was taking a beating last week. Where do you think that sell-off was kind of overdone, or was it a little bit a sign of things to come? So we asked you very, very straightforward. Where do you think WTI is going to settle out at the end of this year? So the end of 2017, do you think it's going to be around where it was? So in the 40 to 45 range, think it's going to be much lower, aka below 38, a bit higher, so in the 50 to 55 range, or much higher, which is above 55. Nick, if you're not looking at the notes, if you're not cheating, what do you think won our poll, and what would your guess be?
Well, I think last week I did listen to the show from last week over again, and when I heard your question again, you had said the end of 2017, and I was thinking I definitely wasn't thinking that far out in terms of my answer, but I said around this level, 45 level, and I believe last week the poll was saying less than 38, so I'm going to just go with the fact that people still think that we have some downside from here.
Yeah, they came in pretty hard on that. About 53% saying much lower, Nick, below 38, which is interesting. It's not exactly. We are seeing that in the vol skew. The puts still have that bias, so in crude, so that is lining up what we're seeing in the options. But it is still a little bit surprising, I think, nonetheless. 27% saying right around the 40 to 45 level, 13% saying a bit higher, and only 7% saying much higher, aka north of 55. So not a lot of love there for the crude bulls out there. All right, let's get into some more of your questions here. This one comes from Andre. He wants to know, pretty straightforward question, Mr. Nick. He wants to know USO, WTI, or XLE. Which is the best way to play a bullish rise in oil? Maybe with a straight call vertical 2 to 3 months out. So he wants to come in, he wants to buy a call vertical, he wants to do it somewhere 2 to 3 months out. We talk a lot of futures options on this show, so we're knee deep in that neck of the woods. But I have a hard time recommending those other products anyway, simply because if he wants a pure spec on crude, the crude future and the options on that future are still the best way to do it if you want, because there's none of the other noise. USO has all sorts of noise, and I lost count of how many people write into us all the time saying, well, it doesn't track crude that well. Well, there's other stuff going on there. There's baskets of things and everything else that they have to take into consideration. So hence, it's not going to track as well. There's some of the erosion that works into a lot of these ETFs as well that comes into play there. So there's a lot of issues where if you want to capture, if you think there's going to be a nice pop in crude, and this week there certainly was, and you want to play that, that's pretty much the more straightforward way. XLE is even more out in kind of left field in terms of what it tracks versus the pure underlying. You're getting into some other names, and you might even be looking into like baskets of crude names at that point rather than crude itself. So if you want a pure play on crude, I don't know, Nick, maybe you differ. I'm guessing you don't, but I have a hard time. Arguing against the product itself and the options on that product. Do you agree?
Yeah, I don't know much about the ETFs, the USO or the XLE, but yeah, from a pure play, you probably want to stick to the actual underlying contract. So the WTI futures and the WTI options. Now, if you go out there and look at some pricing for, say, a dollar wide call spread right now, and let's call it. Well, I guess that's how far we look. So if we go up there, I don't know. I mean, right now for a dollar wide, if you take the at the money into account, say in October, you're going to pay around $460 for a dollar wide to get 1,000 back. So I don't know about you, but that risk, 450 to make 1,000, that's not necessarily a great bet from my standpoint. And then, if you go further out, and again, it depends on what our question, what they're asking. I mean, you can start to go a little bit further out to the 50-51, for instance, and you're looking at about, what do you say here? About $250. So you got a 4-to-1 on a 50-51 call spread, 4-to-1 return. So yeah, I mean, I'm not entirely sure that that's even a great trade, to be honest with you. I mean, it depends on, I don't think you're going to get hit on too much decay. I'm looking at the ACK, which is a 2.5 month. I went right between the 2 to 3 months out. So I looked at the ACK. So I don't know. I would say I would be more apt to maybe sell that call spread than I would to buy that call spread, just because, now you're looking at probably a similar, maybe a little bit better of a chance of not running outside those numbers. So maybe you strategically do a 1x2 or something like that, where you sell a meatier one and buy some cheaper ones to cover just in case there is a problem. But I don't know. I'm not an oil bull right now, just based on how it's traded. I'm an oil range. I'm like, you're on the 40-50 track. That's what it is. So you can drive a big yacht through the middle of that range right now.
Yeah, it's funny. I wasn't even looking at this from a strategy perspective. I was looking at it purely from a product perspective. But you're right. If you start looking at the strategy, yeah, I'm not a huge fan of running out and just loading up on a bunch of upside out of the money premium in any of these. If you got to go WTI, if you got to do this, I would probably do it. I like your way. I also would finance it. So maybe you turn it into a bit of a more bullish risk reversal. You're taking advantage of that skew that is there. We talk about every week. It's not as pronounced as it used to be. It used to be bullish risk reversals were one of the better trades going because the calls were anemic. The puts were super rich. So it made for a nice setup. You collected nice credits. If it did drop to those levels, you picked up WTI at a very attractive level. I would definitely go that route rather than just loading up on straight up out of the money premium. You want to have at least a one or two short legs there to play against and offset all that premium you're going to gobble up. Yeah, I'm with you on the underlying as well. I don't. It's hard for me to see an aggressive, crude, bullish case right now that brings it back up to, let's say, 55 or 60 or something like that in the near term. I just don't see it. With so much production domestically coming online, and the higher crude goes, the more that production comes online, it's a challenge. Certainly, if you get to that 75 range, all the shale comes online. It's a huge ceiling out there for crude, and I have a hard time seeing what's going to push it through that. But that said, purely product-wise, I'm definitely with you on the WTI. I mean, XLE is a sector trade. You get in the whole sector. There's a whole bunch of noise in there that you probably may or may not want, but I'm guessing you probably don't if you just want to track crude. We got a comment here from Morgan, saying, how many Bitcoins? I like this. How many Bitcoins does it take to buy 1,000 tulips? I don't know. What is that? What is that conversion ratio, exchange rate these days, Nick, between Bitcoin and tulips? Do you know?
I just looked it up right now. So $2006, which inflation is a little bit. So we'll call it. It says in 2006, the tulip bulb was worth about 1,250 current U.S. American dollars. So let's call it 1,250, since there's not much change from an inflation standpoint. From that standpoint, so. I think it would take you about a half a Bitcoin to buy a tulip bulb right now, based on that conversion. If we look at the craze value of a tulip bulb, right? Not obviously, he's not asking about a tulip bulb right now. He's talking about the Dutch craze that took place back in the 17th century. So half a Bitcoin is my answer.
Wow, look at you giving an actual answer. I just thought it was funny that he was asking that. It didn't.
That's why we're here, right?
We're here to answer the questions. I love it. The actual conversion rate of a Bitcoin right now versus a tulip, way back when. I love it, Nick. This is why we got you on, so we could so you can give people get the historical perspective on all things tulips. I love it. All right, we got next up. We've got, who do we got here? Let's see. We got LJC6V. Easy for me to say. He says, is gold looking good for a collar here? maybe everyone's in the 2 to 3 month range in all these questions here, Mr. Nick. Of course, callers, listeners are, of course, you're long the underlying, you're long an out of the money put, you're short an out of the money call. So in order to make that favorable to put that on, obviously you got to be bullish in the underlying, but also you got to have some fairly low levels of juice on the puts and some fairly attractive, aka high levels on the calls that make it worth selling. So you want the put to be cheap, you want the call to be expensive. This kind of harkens back to about a year ago when we were talking about soybeans, when it was very favorable for setups because the puts were cheap, the calls were super expensive. You can actually put on collars almost for credits, which is a great thing. You can't get that very often. So in this case, let's pull up the old. I know we just did the quick skew, Mr. Nick, but let's go back to to gold, and let's see exactly how it is lining up here. We were just talking about this before. It was the pronounced sell-off this week in gold, and we are seeing the vol coming in. So the puts are a little bit cheap, which is a thing you might like excuse me, I keep saying crude, in gold collars out here. I'll have to give me a second to pull this up. Mr. Nick, maybe you have it up already. What are you thinking here?
I gotta. Yeah,
what are you thinking here for collar setup sometime in the 2 to 3 month range?
Right. So I'm looking at the SEP contract right now, and I'm looking at it's got 59 days, so we'll call it the 2 month range. 25 delta strike on the downside, it's 12.15. The 25 delta on the upside is the 12.80. So the upside is 35 out of the money, and the downside is 30 out of the money. And right now they're just based on my current pricing sheet with basically a 12.45 future. They're trading at the same price, so that's got a 50 delta. So you can put on a no credit, a no cost. I would, me personally, and I'm like a broken record when I always traded value. I tried to trade value, especially when it came to risk averse. The one time I didn't, that's why I'm doing podcasts. I try to trade value, especially on cheap puts. So I like buying the put, buying futures, and selling the call for zero. The 12.15, 12.80 collar hedged. So you have pay zero premium. You got 50 futures on, and you're long the put, short the call, and you have some move on the upside. That's what I like right now. So there's not much juice though. There's no juice, basically.
Yeah, it's a zero juice trade. I finally got it up here on my screen, and you're right. It is completely flat, which is surprising. So you're right. You can do that for essentially even money. No credit. So if you're looking at it from, hey, I want a huge credit to do it, then maybe it's not that attractive. But if you're looking at saving some money and not paying for it, then maybe it is attractive. So yeah, I'm okay with that if you're looking to put that on. Certainly if you're going to get in some gold futures right now, anywhere, any sort of long underlying trade, you want to have some sort of hedge against all this craziness we're seeing to the downside. I think a collar is a better way to go than just straight up out of the money buying some puts. Certainly. Of course, some of the gold bugs may not like hearing that because anything that involves selling gold on the upside, perhaps they don't like it here. All right, good questions here so far. Let's see what else here's a weird one, Mr. Nick. This one comes in from Fund Concept, going out to Crude. Or perhaps she says, do you think the rise of activist shareholders pressuring oil giants to mitigate climate change can make an impact? And they link to an article in the Journal from this week talking about ExxonMobil and a lot of the activist investors there who have accumulated a total of about $5 billion in stock. So they're not like they're small money. How they're looking to try to tamper some of their claims to get them more in line with things like the Paris Climate Accords and this 2 degrees Celsius increase in global temperature and these sorts of things, and trying to get some more insight into how that would actually impact the bottom line of these companies. And this is not a new phenomenon. We've seen environmentalists and others, make claims and use these meetings in the past to try to make some noise. But this time it's interesting because, as the Journal points out, there's some actual money behind it. They got New York City pension funds, a bunch of other big names are getting 30 investors in total, again, totaling about $5 billion in Exxon stock, who want a little bit more insight into how some of these climate change things are going to impact the stock going forward. So we don't usually talk about underlying stock that much, Mr. Nick, but this kind of debates back into it or leans back into a little bit. I like sometimes when our listeners take us off the rails a little bit. So this, if there ever was a chance of it happening, I think this is probably one of the better ones, certainly one of the more well-funded ones. We don't talk activist investors that much here, Mr. Nick. What do you think about, and in general, it kind of ties back to all this kind of climate change talk and the impact on crude going forward too. What are your thoughts there, Mr. Nick?
Well, what would be nice and what my thoughts are two different things. It would be nice if this actually made a difference where you can get some people to sort of put a little bit of heat on these guys and have them make some good decisions. But generally speaking, I think a lot of them are going to move toward trying to just do what's best for the bottom line of those companies. Now, yeah, they could pay some lip service and maybe do certain things to appease them, but the activist investors are also interested in a profit of their holdings as well. So I think everybody would like to see those kind of things work, how much they're going to work. And like you said, it's got a good chance here given the amount of holdings that they have. But in comparison to the market cap, I don't think it's all that much, right?
Yeah, I mean, I think best chance is still slim, but it's the best they probably have had in quite some time. But you're right. If you're active in the climate movement or interested in this issue in general, and maybe this is the time you'll make your voices heard at names like that. And at least $5 billion are going to be behind you at this type of event. Again, the broad impact on crude still uncertain, but it is interesting nonetheless. Nick, we talked a lot about corn vol last week on the show. We started off, I think, with a question from Ron Switzerland. I like that handle. He was asking us what we thought about corn vol before the next USDA report. That kind of kicked off a lot of people chiming in what they thought about it. Who was this? Gary Fryat said, it can't get any cheaper. I guess it can. We had other people chiming in. Ron coming in again saying he's more of a seller. He kind of clarified what he was asking a little bit later, saying he's more of a seller of option vol. And since the market always pre-prices the USDA figures about 7 to 10 days out, he was looking to sell some corn vol about 7 to 10 days out before. And then I'm guessing probably buy it back right around the event. Probably not ride it through, but maybe. And yeah, so a lot of back and forth on that. I think I know you chimed in on this probably a little bit as well. I like to see the conversation going during the show and even keep going after the show. It's always nice to see people going back and forth. But corn, very much on people's radar still, Nick, and corn vol. How many times have we said that on the show? Not many. But corn vol clearly on their radar. And of course, can't get any cheaper, right, Nick?
Well, it didn't get cheaper this week, but I think that wheat had a big jump right this morning. So that's, I think the other ag sort of followed suit after that. If you looked at that chart, it was just a tremendous jump. So it could always get cheaper, right? I think that's what Gary, Gary used to be a customer a long time ago when he was doing fixed income stuff. And he's saying we always used to talk about how vol couldn't get any cheaper, but inevitably it does. So that's why, going back to even, somebody wanted to get a longer call spread and stuff like that. I mean, those are probably the only way to get long vol right now when it's sort of depressed and kind of moving sideways and trickling down so when you're kind of pretty flat on the volatility side. But it could always get cheaper. It could get more expensive, but generally it doesn't get that more expensive for that long. So, like Ron said, it's sort of event vols. Get the event vol pump, and then you get a little bit of the air coming out of that vol tire as you approach the day where some of the questions get answered. So it could always get cheaper, though.
All right, let's wrap it up with this one. Let's end it with a silly one going into the holiday weekend here, Mr. Nick. This one comes from Engine 9, and he wants to know, perhaps she... what is the craziest option on the CME system?
There's
a lot of things. Obviously, I was kind of digging through when I read this question. A lot of things. We often joke about lean hogs here on the show, #HogLove, but you guys have heard of that, so maybe that isn't that crazy, even though they trade kind of crazy sometimes. Maybe it's got to be probably, I have to lean, Nick, probably in the livestock or maybe in some of those weird esoteric dairy products like the dry whey and, mid-sized milk and class 3 and 4 milk and all these other things. Maybe something around there, or you got something even more esoteric up your sleeve.
Well, I actually like that question because we just built a CME Group product browser, and I'm in it right now, and that's going to go live at some point next quarter, where you'll be able to browse all the products and get easy access to expiration calendars and block trades and assorted other information. So I'm perusing it right now. I'm looking at you mentioned dry whey, so that's kind of an odd one. Non-fat dry milk in the dairy. The rest of them are all sort of plays on the different commodities. You're getting commodity spreads and, just calendar spreads. But let me run through here real quick. The energy usually has some whacked out stuff. I mean, you can get the energy's got just all kinds of goofy stuff where you get options on strip spreads and stuff like that. But I think if you're looking for something that most people here's a funny name, right? Freight route TC2 Baltic average price options, right? So,
my favorite.
Yeah. So, I mean, you got those kind of things, and I don't know how much those trade, but you do have a lot of wacky energy product options. But I think and you got real estate options, you have weather options as well. And you have, if you ask what futures are, you can have, they have just the craziest. They have seasonal strip futures for the weather, all kinds of, and it's the summer and the winter. But I'm going to go. You said it, and I think you just sort of roughly mentioned it. But how many people would think that there's non-fat dry milk options, or dry whey options? Or if you saw last week, you might have noticed that they moved the cheddar cheese auction. They moved it off the floor, right? Did you see that news?
I did not see that, no.
The cheddar cheese auction is now moved off the floor.
That's like a headline from 1873.
Right. But there were people that would try to manipulate the cheddar cheese market. So just think about that. That's almost like a Tom and Jerry episode where they sort of humanized for a while. And they're trying to, which one? Tomcat and Jerry Mouse, right? Is that what it is? Tomcat
Yes.
and Jerry Mouse, yeah. So Jerry's trying to force the market down, and Tom's trying to force just the craziest thing. So let's go with. How about we go with the cheddar auction, the cheddar cheese auction, and the dry whey options? How about that?
I'm okay with both of those. There's a lot of fun. I'm just scrolling through here while you're talking. There are a lot of fun names. We don't talk uranium enough here on the show. We don't talk anything about lumber. We got to get some lumber going on the show a bit as well. So there's a lot of fun names we can maybe get into on future shows. Let us know, listeners. Hit us up if you want us to get into literally the weeds sometimes of some of these products. But there you go, Engine 9. Those are our takes for the craziest options over there on the CME system. That's going to do it for your questions. It's also going to do it for this fun pre-holiday episode of TWIFO. But before we go, Mr. Nick, what's cooking? Give us a glimpse. You mentioned one of them already, what you guys are working on. What else you guys got coming in the hopper over there at Quick Strike?
Let's see, some good stuff. I think I could mention today. What do we got? I've always been sort of disappointed with our chart coloring, so that's a new release is coming this weekend. So we have a much better chart coloring when you go out there and start plotting vols against each other. I think you'll see a lot better stuff, as I just mentioned briefly. There's going to be some cool tools that allow you to really easily navigate the CME Group set of products and get access to expirations, block trades, maybe some contract information, as well as maybe some pricing and that type of thing. And what else we have going out there of late. And then for this next quarter, if you are using CME Direct, just keep an eye on that CME Direct Quick Strike integration. It's just going to get more and more fun. We can officially, I guess I can officially say it since I got all the domains now. We're going to have an Ask QS. You'll be able to ask QS questions and get some answers. So you'll be able to say something like NFP, and you'll be able to get the non-farm payroll numbers. You'll be able to say LOATM, and you'll be able to get a straddle run for the crude oil, stuff like that. So, that's coming down the pike as well. So I remember I wanted to rescind that comment at some point, but now since I have all the domains and stuff out there, we're gonna be seeing that in the near term. And we've been working on a Quick Strike mobile app for the iPhone and iPad, so we should see something with that in the next quarter as well.
Oh, now you're playing my song, sir. I like that. That would make these sessions from the Southern studio and elsewhere much easier. So it all comes back to me, sir. At the end of the day, that makes my life easier. So
always.
I like that, and I know a lot of our listeners like that as well. So well done on that front. I'm looking forward to asking Quick Strike some questions too. Watch out, I may plague you with some weird ones throughout the week. Like, what about uranium? What's cooking there?
If
all
we see
sorts.
it, yeah.
All sorts of other fun stuff. Check it out, listeners. Also, make sure you check out that CMEgroup.com/TWIFO. You can keep up with the reports throughout the week. They keep updating. You might have to just play around with that expirations tab there so you can change it to, last week, so you can see exactly the report that Nick and I were looking at during the show, or you can keep it up to date and if you want to check it next Tuesday, for example. You can. It's always updating throughout the week. So check those out while you're over there. Maybe you want to learn a thing or two. The CME Institute is a good place to start as well. Don't go to cmeinstitute.com, though. That's for mental health. You don't want to go there. Go to institute.cmegroup.com instead, and that will get you started answering some of these crazy questions you guys send us. They may have some answers for you, so check them out over there. And on behalf of Mr. Nick and our friends over there at CME, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, sending in such great, many and varied questions. Keep them coming. We read them all. We don't get a chance to answer them all, except for the fun ones. And we'll see you next time for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.